So hey guys, today we're going to be talking about ROI, or return on investment, and how you can calculate your return on investment. So return on investment is a performance measure used to evaluate the efficiency of an investment or compare the efficiency of a number of different investments. ROI tries to directly measure the amount of return on a particular investment relative to the investment's cost. To calculate ROI, the benefit of an investment is divided by the cost of the investment. Okay, so let's use calculator to calculate ROI. Okay, so let's say stock XYZ, you bought it at $100 and right now it's at $150. So how will you calculate this? So final price minus the initial price, which is equal to $50, divided by the initial price times 100 to get it in percent, and you get 50%. Yeah, so if you buy a stock for $100, it goes to $150. That's 50% return. So as we could see, it's this is how you calculate ROI. So let's say let's take a couple different investments and compare them. So let's just say let's just take Apple stock. So the thing is, for stocks, to calculate ROI, you can literally just do this. That's all you have to do. So if you bought it 6 months ago, your return on investment would be 11.15% plus dividends. So it'd be around 13%. If we take it 5 years, it would be 124%. If we take it max, it would be 47,000%. The fact is, why do we use ROI? So we can compare two different investments. So let's say we take a company like Shopify, Amazon, Apple, whatever it is, and we take it against the S&P 500. So would you just take ROI, or would you take something else? So let's take Apple. It's past 5 years, its average ROI has been about 15%. And we take S&P 500, it's over the last 100 years, its ROI has been 8%. Okay, so what would be a better investment in terms of ROI? Apple. But if we take Apple's risks and let's just say bad news happens and there's a whole bunch of tariffs or something on Apple would completely crash. But let's say on the S&P 500, if one of the company completely goes bankrupt, not much happens because S&P 500 is more diversified. It's the top 500 companies. So if one company's gone, then we still have the other 499 left, and another company comes in. So if you guys don't just compare your investments based on ROI, so if you also take your investment based on risk, if there's a lot of risk but there's also a lot of potential for high ROI, or if there's investment low risk but low ROI, which one would you take? It really depends on how you're building your portfolio. So this is how you calculate ROI. Leave a like and subscribe. Sorry for the short video, but some people need to know how to calculate ROI to compare two different investments. So leave a like and subscribe. If you want to open a brokerage account in Robinhood, just use the link down below and you can get stock up to $200. Leave a like, subscribe, comment down below what videos you'd like to see, and thank you.